Everybody, Michael Martin, thanks for being here. So, following on from last week, got a lot of great feedback, a lot of great questions. And so, what I thought I would do is kind of continue the conversation as that's typically my style. A lot of comments came in about getting whipsawed and, getting this and that. And what it occurred to me is that people were trying to buy the bounce, meaning, the overall move in the market is weak, right? The market has rolled over. There's fear and uncertainty. And I think in your mind, you're like, well, a certain stock or index has come down far enough. How much more could it go? It's got to bounce from here. That type of mindset will get you killed in trading because what you don't know is that markets can overcorrect to the downside. They can certainly trade, and overcorrect to the upside, although most people don't think of it that way. They think frothiness or they think of bubbles, this and that. But the truth is, most people like recessions. You don't know you're in one. They tell you're in a recession, but you typically have been in one for 4 to 6 months before the time they tell you. So you, as a trader, you have to develop a feel and an understanding of how markets work, because you're not just playing like at a poker table. You could have pocket aces on the button, but someone who's playing 2-3 offsuit from out of position could flop a full house and crack your aces, right? And so your goal is to really learn how to read the market as much as it is to have a strategy. I know it's popular to think like a contrarian, and I generally do that. But it's another thing and separate thing to try to think that I'm going to just make my money by fading all the moves. In my humble opinion, that takes a great sense of timing, not just awareness of charts and patterns that you can see in whatever time frame you're looking at. It's usually a short-term type of a thing for most folks when you're fading. But that's something that you would absolutely want to do on the paper trading side, because when you're looking at short-term data, like say 1-minute bars, right? Anything intraday, even for that much, you have to understand is very random as far as data is concerned. And I was talking with a former client via email, and they were looking at, buying and selling breakouts. And one of the oldest tricks in the book, it's been around forever, is to look at the first 5 minutes of trading in 1-minute bars, establish a high and low, wait for a breakout above or beyond, wait for the retest, and then trade whatever the direction is after that. That's been around forever. People write about it like they've invented it. It's also a good continuation pattern, by the way. If you believe in fractals, I kind of do and I don't. But just remember that the shorter term data that you're looking at, meaning 1-minute bars, is fantastically random than say looking at a daily or a weekly or a monthly. Like those are the charts that really tell you stuff. Now, that might not resonate with you if you're trying to trade on the short end, but you have to remember the people who are in control of the market right now, today is Saturday, March 15th, beware the Ides of March. And looking at the previous week and the previous couple of weeks, sellers are in control of the market. So you can talk about where's the trend and all this and that, but like sitting at the poker table, if you are short stacked with chips, meaning you're a newer trader, you don't have a lot of money to lose, the last thing that you want to try to do is start buying this market long, i.e. fading the move. Now, if there is a capitulation, which you kind of get to define yourself, usually it's a big sell-off, a gigantic kind of, we used to call it a long ruler day back in the days where we had these 2-inch rulers and we were doing it, keeping the charts ourselves because there wasn't an internet, right, or anything reliable in terms of being able to get price data online. You had to do it by yourself and kind of keep your own charts. So that being said, I do think fading can work, right? In fact, I know lots of people who do it. But you have to understand, if you're going to fight the people that are in power right now, who are the sellers, and the people who are the doubting Thomases of the world, you could inadvertently be kind of taking it on the chin just because you have that mindset, but you're trading against the grain. The tide is going a certain way and you're trying to fight it. So I do agree that it is a viable strategy, But just like with a lot of short-term trading, I think you have to develop a feel. And that feel is your asset, to be honest with you. It's not the chart pattern. It's not knowing about the 1 minute bars and setting up the range and knowing all that. That's been around since before I started, in the late 1980s. So it's nothing really new. Um, Now, why don't I do it myself? Well, for one, I don't want to be exchanging my time for money, basically. So it goes against my overall ethos of having to sit in front of the screen. I'd rather delegate it to somebody else. Trading is a business, and I want to be a business owner, not a business manager, right? I don't want to be an owned and operated by Michael Martin kind of a deal. You might feel differently, and especially if you're just starting, it's like, hey, I'm excited about all of this stuff. Trust me when I tell you, and look me in the eye here, that feeling has vacated my body. I don't need that. Two, I get up and start looking at things at 5 o'clock local time. And so I don't know about you, but I'm not particularly sharp at 5. I have my wits about me. You hear me speak. I know what's going on. I can put my ear to the tracks. But I don't want to have to be sitting at my screen making important financial decisions. Two, if you look at the type of size, right, it doesn't pay enough money for me for the effort that I would put in. Now, for some of you, we're going to talk about this as well today. What I'm going to try to do is put several ideas into this video because I just don't have the bandwidth to do it all week. So I'm going to have to try to consolidate everything into one, perhaps slightly longer episode than I had been doing up until like through the fall of last year, when things just got too busy. And I had kind of given everybody a warning. I said, there's going to be a point in time where I just don't have the bandwidth, or I run out of things to say, right? So everyone was making money. This show is kind of for people who need the advice, need the help. If you're more established, it might be a good reminder for you, but you probably don't need to be here. This is more for people who are trying to figure it out, and my giving back to the community. So again, to reiterate, I think fading moves is a viable trading strategy. But with that, it's not about the chart pattern as much as it is your feel. And in that is where you create your edge. So if an allocator looked at you and said, what's the Johnny Magori, you'd have to be able to say, well, like, I look to fade moves, here's the strategy, and here's how I pull it off. Because that's what they're betting on. The trading strategies, there's, like John Lennon sang in one of the songs, like, there's nothing you can sing that hasn't already been sung. Like, everybody knows. Like, it might be new to you, but it's not new to the overall trading community. You see what I'm saying? If you've been around long enough, like I've been, or like Victor's been, we've seen almost everything under the sun, right? Yes, high-frequency trading was a new thing, but that was more of a technological surge and programming more than it is actually trading, right? And plus, they had to change the rules because if you were going to front run your clients, like, that was typically a no-no, right? Front running. So I think what you need to do is first you have to understand the power of the overall movement, right? If the tide's going out, there's really nothing you could do about it. And if you are a long-only person, don't force the issue, right? There's nothing worse in life than somebody who's forcing something in a friendship when it's just not there. And romantically, it's even worse when you try too hard. You have to let the stuff unfold and learn to live with the uncertainty. And in that is where the money's at, right? Because, like I say, and I've said before on the show, there are two outcomes to any particular trade, right? There's the financial gain or loss, but then there's the emotional part, the trading, the psychology, the emotional intelligence part, and that's all wrapped up there. Now, for everybody, it's not necessarily 50-50. Some of you might be more about the money. Some of you more want the emotional win. And it's not good or bad. It just is what it is. But generally, and there might be another thing or two, but generally speaking, the top two things are, what's the financial payoff, and then also what's the emotional and psychological payoff. So just like in life, for the chances that you want to take in your love life, and your work life, and your trading life, you have to understand how to live with the uncertainty, because that's the emotional risk that you have to go through. A lot of traders who trade the short run, they don't either trust themselves or they don't trust the markets, and they kind of bite their nose to spite their face, and they can trade and they can make money, but if I oversee that, trading, um, and look at the results, oftentimes you can see that they're leaving a lot of money on the table because they're unwilling to deal with the emotional uncertainty. So that's a human issue, right? That's a personal growth issue, and that can be worked on, right? Because you can journal whatever your feelings are of like, why are you taking your winners too soon? Why? And I talked about this before. Why would you just offset a particular winning trade at 3R? Right, as opposed to maybe just trailing with a consistent 1R stop all the way through to just see where it can go. The ethos being, if you take everything at 3R and say, that's it, I'm done for the day, you rob yourself of the potential 5R, 10R winners that are out there. And it's those types of trades, when you really think about, Pareto, it's not even like 80-20. It's more 90-10 or 95-5. You might find that you can catch a couple of good moves and really just one or two trades, even if you're in and out, if you can find 2 or 3 moves that are pronounced over the course of a year, you can trade those moves. Like, say, Michael Marcus and the guys in Commodities Corporation were trading gold when it was like 50 to 100 an ounce, and it went to 950. They were in and out of that move. It wasn't a buy and hold per se, taking gigantic chunks, out of that move. You can learn to do that too. The best you can do, to me, while we're on the subject, is stay with the overall direction of the move. But make sure, if you are trading that 1 minute, that 5-minute trading strategy, that open and low range means something in the bigger picture, because it's absolutely important to know your levels. And if you're doing short-term trading, intraday trading, swing trading, you still want to know, like, and this is what I was talking with the client, looking at, say, like a 4-hour bars. To just sell a 4-hour bar, what the hell does that mean? Like, what is that 4-hour bar or low if you're going to sell that move short? What does that look like for the day? What does that look like with respect to, the week, the month, the year? Like, know your levels, go back into higher time frames, because those are much more material. So then if you tell me like you're gonna buy or sell or fade a certain move, you need to know where the prices are, what the higher levels are. Meaning not just the daily high and low, but what's the weekly, the monthly, the yearly, the year to date, that kind of a deal. And then if they conjugate, right, and this is a problem, especially if your account is underfunded and you're looking at MNQs or MES, MEH, I don't know, the smaller micro contracts, you might not have enough money to expand your horizon. And that's why you're forcing trades, because you don't have enough money in your account, right? So you find yourself putting on trades because you don't have anything else to do. There's no other vehicles that you can really afford to trade given what the margin rates are, even though they vary widely from one broker-dealer / FCM to another. In those instances, then, as far as I'm concerned, I would say you'd have to sit and wait. Even that means not participating, and it's painful for you to not participate. Again, that's the emotional part. What are you doing this for? You have to know, like, when you look at the two sides of it, right? You have your emotional brain, you have your financial brain. Which of it what are you trying to fulfill? Because if you're looking to do this for happiness, I think trading is kind of a manner of being. It's a group of behaviors. But it's not necessarily a higher form of life. It is what it is, right? I mean, A is A. And if you have it, then great. But if I was going to try to fade or buy breakouts or fade moves, I would absolutely know what the levels are on higher time frames to know if my 4-hour bar, for example, is material or not. Because again, if you're looking intraday, the data is very, very random. And that's what might be driving you damn crazy, is that those chart patterns aren't necessarily, you have to think about reliability, right? So know your higher time frames first. And then if you want to kind of break it down to intraday stuff, see where those levels are when you conjugate them to the higher time frames. Because then to me, the signals will be much more meaningful. Otherwise, you could be figuratively going outside on a particular day when there's a potentially strong gust of wind going by and misinterpreting it for the oncome of or the onset of a hurricane or a tornado, and it just could be a vehicle going by, right? Or a gust of wind temporarily. So that goes that. Now, as far as maximizing those opportunities, which is really the next part of it, be mindful, right? If you're just getting your feet underneath you, it's fine to start and say, okay, I'm going to risk $200 to make, say, $6. I would think of it from an expected value standpoint and not necessarily worry about accuracy or needing to win 7 out of 10 times. You can make a lot of money, and Jason and I spoke about this on the Crowded Market Report interview that I did. I'll put a link in the description if you haven't already seen it. That with something that would be an absolute, like, I'm unprepared for the test kind of failure grade, 30%. You can still make boatloads of cash if you have great asymmetry between your gains and your losses. And the goal for you, I think, if regardless of what time frame you want to trade, is to find those asymmetric scenarios. 3-to-1 is definitely asymmetric, but the question you have to ask yourself is, for all the time that you want to put into this business, is it enough of a payout? Because you get to decide that. It's a completely subjective decision. There's not any one particular answer that works for everybody. So, for again, as you get older, you lose your legs. You don't want to be sitting in front of the screen, because the whole 3-to-1 thing it's not as exciting. Like, once you have enough money, so your needs might change over time. So what worked over one period of time might not satisfy you going forward, right? You can listen to that Nate Bargatze joke where he talks about, you're going out in your 20s and your 30s and your 40s. And he's like, in your 20s, your buddy call you up and say, hey, man, we're going out. And it doesn't matter the day, doesn't matter the time. You're just so excited, you're just going to drop everything and go. And in your 30s, I don't steal the punchline, there's much more criteria, because, in your 20s, you would have gotten a lot of it out of your system. So it's like, who's going, where is it, how far away is it? And then, he says, I'm going to drive separate, which is very, very true. Then you get to your 40s, and you get all that out of your system, and your buddies call you, say, hey, man, we're going out. And, again, the punchline is more along the lines like, I'm angry that you called to think that I would want to go out. Because over time, your needs and the things that you like to do change. So I think trading is the same way. What is your why? Like, what are you doing it for? Do you want to say that you're a trader, right? Do you want to be a cop, or you want to act like a cop, right? Remember from The Departed? So there might be a little bit of that when you're in your 20s. I want to be able to say for my sense of self-esteem that I'm a successful, who knows what accomplished means, but I'm a successful trader, meaning that with the skill set I have and my sense of timing, I can take a block of cash or a line of credit and increase it, whether it's my money or somebody else's money. And that can be very rewarding from a self-actualization standpoint, right? I can feel good about myself. I have self-confidence. I can increase my self-esteem. For me, if you know my story or have gotten into the Inner Voice of Trading, the audiobook, don't forget the link. If you haven't gotten it already, the link for the free audiobook of the Inner Voice of Trading is in the description too. I was trying to escape my life as a person depicted in a Raymond Carver short story of blue-collar despair. And it's a constant theme in my life. Is like, I don't want to exchange my time for money. When I was working as a caddy, I had to show up caddy golf bags. When I went to work as a waiter, mafia joints or not, it was, I had to exchange my time for money. So I needed to escape. Because remember, folks, when they talk about middle class, lower class, upper class, they'll always talk about some kind of income bracket. But that's like looking at the runny nose of the cold. Remember, behavior predicts where you end up in life. And this is very important, so understand this. Middle class is not an income bracket. It's a group of behaviors. So if you feel like you're lower middle class, whatever it might be, all you have to do is change your behavior. And that kind of predicts your outcome, right? It works for almost everything that I can possibly think of. So I was always on a constant battle to say, like, okay, I have amazing parents. They were my best friends. They're both since passed away. And I loved them dearly. I talked to them all every day. Taught me great, great things. I was very, very lucky that way. And I felt when I was thinking like this that I was betraying them because they were Depression era, right? They were both born in the Depression. And so that, you know how we talk about like our environments shape us, right? That's why I don't get into this like my feelings are facts, it's blue, it's red, this and that. Like that, it's all bullshit. You have to be objective, in my humble opinion. You have to see the good and the bad from both sides of the aisle. And like in life, I just didn't want to. My sister and I had great work ethic. We had grit because we grew up in that type of an environment, thanks again to our parents. But we also were very well educated, and then we got to learn how to use our brains. So and this is part of the puberty of it, if you will, is that I took a blue collar working class mentality of working long hours into a white collar intellectual property type of job. So my battle, even as I'm sitting here now, is to make sure that I know what do I have to do from an oversight standpoint. Who are the best people that I can delegate stuff to? You know, because again, I want to think more like a business owner, not a business manager. When I first started blogging in whatever it was, '05, and doing interviews with friends of mine who had written books, I was doing everything. I was doing the recording and trying to make thumbnails, and you know, the technology wasn't where it is today, and where to find the right people, the freelancers, if you will, to kind of help you wasn't as established either. So, and plus you don't have the revenue to pay these people. So a lot of it, you're bootstrapping it, and you're doing everything. You know, you're creating the content, you're doing the marketing, you're doing the trading, you're keeping your general ledger, you're communicating with your clients, you're trying to get allocations. Like, it's an enormous amount of work. You have to be fantastically organized. So that's really all I have to say about that, is make sure that you know what you're doing it for, and what are you worth, right? What is your time worth, but then what are you worth as a person? Because I will put it to you this way. Say, for whatever reason, you said, I'm going to risk 200 to make 600. The question is, how did you come up with the 600? I know it's 3R. But why is it 200? Is that based on a percentage of your overall account? Right? Because you could easily say 1,000. I want 5 to 1. I want something that's even more asymmetric. Now, that might require you to hold your positions longer. It might require you to find another setup. It might require you to develop a different sense of timing or a different move accordingly. But that to me is mindset. I'm not saying that it's small-minded, because that would be, you know, kind of condescending. And I don't know enough about the folks here specifically. I don't know enough about your specific situations to say. You might be doing just fine. But again, what gets measured can be improved upon. And, you know, I'm trying to drop some wisdom bombs here for you to be able to become, you kind of like your own best coach, your own best mentor yourself. And I feel like if I do enough of my job here, I kind of make the channel obsolete for you, because then you could become a person who thinks like me and take your life to new heights that you couldn't have even fathomed. Remember, you have to have goals. Goals mean growth. So how did you come to your decision that you wanted 3 to 1? Is it just because it's popular and you saw that outside? That's okay. I'm rebellious enough to want to challenge that and say, okay, for the amount of time and the amount of hours that I'm putting in, I need more. And it's not about greed. It's just a mindset that I'm worth more. My time is worth more. I'm worth more as a human being for the efforts that I'm willing, because I know what I'm about. I know I help other people, so I know goodness is coming to me. I know it might not come from the people that I'm helping, but it's coming from somewhere. That's an absolute truth as far as I'm concerned, for me. So you can change And again, I'm not saying that 200 is small. I don't know what it is for you. You can figure that out yourself. But you can absolutely change your mindset to say, for the work that I'm doing, instead of just automatically having a sell limit above the market to take me out at 3R, I can just trail one of two ways, and I use both in my personal stuff. In the stuff that, with Victor, it's purely systematic, so there's zero discretion. But that is, do you trail structure or do you trail, which is trailing price? I would say trail structure. An example would be, to sell under support, for example, if you're long, or use, a 2B reversal, that kind of a deal. There's a million rules you can use. Or do you trail by a fixed percent of your account? Now, you can vacillate between the two because you can define both. I always start with the idea, like, how can you get the best possible exit for the type of market that you're in once you're in the trade? If there is no structure, then you absolutely have to default to a percentage-based stop, right? But if you're going to risk 200 and you're going to try to make 6, when you're at +6, why not stop it at 4 and see if you can't turn your 6 into 7 and then stop it at 5? Because you were willing to lose the 200 if that was your R. And I'm not saying that's good or bad or whatever. It's personal. It's your choice. But think about, what is that number then? Because if you just offset, quarterize all your winners at 3R, you don't get the benefit of the outliers that you actually need that can really make your year and really beef up your rate of return and your numbers, right? Because as I've always advocated, if you're good at this and you do have skill, you can scale it. And that could be by trading other people's money, opening up accounts, being a professional, or getting allocations from any number of professionals, or joining an entity and sub-advising on something like that, because most of these strategies are scalable. So again, you can vacillate between, do I trail structure or do I use a percent-based stop? Over time, you can develop your feel to see, like, okay, for the type of market that we're in, there really is no, if the market's going up 45 degrees, there might not be anything other than a trend line, right? So that could be, I guess, the structure is, what do you use as the trend line? Do you draw a straight line from the low to the low above the highest high? Or do you do something a little more dynamic and use, a 20-day exponential moving average, for example? You can pick whatever one suits you best, but it gives you more options so that you don't feel compelled to have to just have this hair trigger response to offset an otherwise winning trade. Because, they might be, especially in the type of market that we're in right now, they're hard enough to find in the first place, right? So if you do have one, you might find, like, and I've had this happen before, where there's been years where, of course, I was trying to make, 100% or more, but you end up making 9.5%. Why? Because the market's just never really followed through. So then you go back and you look at your trades and you say, okay, what did I do here? How could I have improved the situation? Because you're always doing kind of like a post-mortem and looking at your behavior. And this is as a pro, right? This isn't when I'm starting out. And I'm like, well, I did the best I could with what we knew at the time. And if it wasn't for letting my winners grow, there was really like maybe 1 or 2 trades that really made my whole year, that offset all the other stalls and all the losing trades. And that's just the way life goes, right? You don't get to unfortunately, you don't get to pick your markets. They are what they are. And you are kind of a participant in something that's much bigger than you. So if you're struggling with where to take winners, and or where, with that, where to put your protective stops to get you out of your winning trades, think percentages and or think structure. Right? And don't worry about the game, like the number, like, oh my God, I got 600. I can't let that go. Like, you work on the uncertainty, because that's the emotional part. You don't want your emotions to overcome good trading rules. So there's a certain kind of maturity that needs to come when you have a winning trade to let the thing go as long as possible, even if you're an intraday trader. Right? Because then you could look and say, okay, well, here's my entry style, here's my trailing stop. I'm either using structure or percent, But now I can marry that and start to build the song. Here's the verse, the A section. Here's the bridge. There's no bridges anymore, by the way. Where's that confounded bridge? Um, and then what's the chorus? So think of the chorus as like a continuation pattern, and start to build it out that way, so you can have, greater gains for the trades that you're already in. But I think emotionally, because you know what the finance is, learning to live with the uncertainty is going to actually help you make more money, because it's the fear, which might not be unwarranted, where you're so happy to be naked in bed together, so to speak, that you're not present to actually enjoy it. A lot of the short-term traders are in that mindset too, like, let the thing evolve a little bit, let it breathe. And I think that'll help you perform better. You will have to go through some trial and error for sure, but it's not going to kill you, right? You get to evolve, and then you say, Michael's onto something here. I can now wait and trade for, 5R winners. Because once you do that, and think about it, if you have 50-50 odds with 5-to-1 asymmetry in your payoff, you're going to make ungodly sums of money. Because once you get that down and you evolve from an emotional standpoint, which isn't going to happen overnight, it doesn't for anybody, myself included, you realize like you already have the skill set to create the alpha. Now's the opportunity to kind of accelerate that, you see, and bang it out. And the last thing I want to address, because again, I'm going to try to do these, instead of breaking them out and doing them Monday through Friday, I'm going to try to address as much as I can in one episode. And again, I appreciate if you're still here, all the feedback. There wasn't I didn't abandon the channel. I just have priorities. And as much as I want to help everybody, and I did get 1 million emails from people, which I respond. I respond to all the comments. I respond to all the emails. And if I don't know, I say so. I'm like, Jesus, it's over my head. I don't know what to do to help you here. But the last thing I want to address was like, we talked about like what are the criteria that you look at in your setup that you need to have occur so that it's a green light, all systems go, I'm going to enter a trade, right? And a few people asked about this, one in the comments, and then I got a bunch of emails privately. And so I started to think about what would be a good analogy so that the light bulb go ding, 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 get the light bulb kind of go off here, and think like, okay, what happens if most, and I don't know if there's 5 things or 10 things that need to line up. The more things, it's like, okay, it has to be leap year, for God's sakes, to be able to put on a trade. So I just find like the simple models are the easiest ones to execute. But you figure it out. He said, what happens if most of the criteria are there, but not all? What do you do? And over 36 or 7 years, I've jumped the gun, and I've also waited. It depends where my head's at. Why did I do certain things? I'll have to think about it and maybe do a deeper lesson on it. It depends where I was in my trading. If the markets were super hot, like 05, 06, where my average winner to loser was like 6.5 to 1 with a 60% win rate, again, those were the markets. Sometimes they show up. I don't think I've seen anything like that since. In terms of my numbers, imagine you're with a loved one, your beau, and you're planting like it's a 3-day weekend, and you're going to jump in the car and get away, go somewhere. What is the process? You got to get the reservations. Maybe you need a babysitter, your dog sitter, whatever that might be. You got to leave the house a certain way. Got to pack all the stuff that you need or that you want. Maybe make a reservation or two for some places that you want to go. But you don't leave the house with a quarter tank of gas, right? That wouldn't make sense if you were going to drive. Flying is a different ball of wax. If, say, like here, people drive to the desert, and when they say that, they typically mean like the Palm Springs area, maybe go to Two Bunch Palms, that kind of thing. That's typically what they mean. Or they drive out to Joshua Tree, or any place where it's going to be 2-3 hour drive, perhaps, maybe a little more. Go down to San Diego is about the same, depending on the day and the time that you leave for traffic. So I guess the point that I'm making is you wouldn't make all these other plans and then leave with a quarter tank of gas, right? So think of that as a terms of like, what are the criteria that you need in order for you to enter a trade? Why would you jump the gun, if that's what you want to call it, or put on a trade when only, say, 3 out of 4, 3 out of 5 things, whatever they might be, have aligned for you to do that? Because again, if you go back to what my ethos is that there's two outcomes to every trade: the ones that you put on and the ones you take off. And that is ex ante. What's my ex ante expectation of putting on the trade? Then you reconcile it with the ex post realization of what actually happened. If you find yourself in a spot where, say, you have 5 criteria that you need to have exist before you put your order in, and you only have 3 of them, what needs are you meeting? Right? Are you afraid of missing out? And can you process that feeling in another way, away from the market, without having to risk real money? You see? Because as far as I know, the markets are probably going to be around forever. And if the criteria aren't there and you have to sit on your hands and wait and or not trade on a particular day, that's okay. There's no rule that says, even if you're a day trader, that you have to trade every day. Especially if you're looking at indices, there just might not be an opportunity. And so if you use that 5-to-1 perhaps rule of asymmetry, meaning I risk 1R to make a 5R move, that can help you filter, and that might change your level of accuracy. Right? You'll have higher payoff. It might also change your win to lose ratio. You see? So think about that. What needs are being met if you're going to have a model or a set of rules that are half-assed or half-baked because the rules and the criteria aren't there in order for you to kind of launch your rocket, so to speak. You see what I'm saying? Anyway, I appreciate y'all being here. Please like and subscribe. Leave your comments. I reply to everything. And see the links below. I got the free download for the audio version of the Inner Voice of Trading. I'll get the link for the interview with Jason Shapiro at the Crowded Market Report. And as always, there's a bunch more videos right here if you like them. I'll see you next time.